When people ask me how to become wealthy, they usually expect a trick, a ticker symbol, a sector, a secret loophole, a clever piece of tax engineering, a phrase that sounds sophisticated enough to make them feel they are finally getting access to the room where money is really made. I understand the desire. The financial world is full of salesmen who have trained the public to expect complexity, and complexity flatters the ego because it makes people believe the answer must be hidden. But if you strip the whole subject down until the language gets plain and the excuses lose their color, there are not many ways to get truly wealthy. There are really only three. You build the machine, you buy the machine, or you enter the machine and convert your income into ownership until labor becomes optional. That is the whole map. Everything else is just a variation of one of those three routes, or a temporary illusion mistaken for a route. I do not say that to make the journey sound easy. I say it because clarity is one of the few advantages ordinary people can seize immediately. If you do not know what game you are playing, you cannot judge whether your current behavior is even moving you toward the right field. That confusion ruins more financial lives than bad luck. Most people work hard. That is not their problem. Most people are decent. That is not their problem either. Most people simply never understand how wealth is actually built. They think wealth comes from effort. It does not. They think wealth comes from income. It does not, at least not directly. They think wealth comes from intelligence. That is not quite right either. Wealth comes from ownership of something that scales, compounds, or continues paying after the labor that started. It is no longer required in the same proportion. That is the center of the matter. Everything else is decoration. Labor is honorable. I have always respected useful labor. But labor by itself has a ceiling. Ownership does not have that same kind of ceiling. A person earning $300,000 a year can be doing wonderfully well by ordinary standards, and yet that income still grows mostly in a line. He can negotiate a raise, he can become more valuable, he can change firms, he can take on more responsibility, he can work more hours. Fine, but in the end the structure is still anchored in some way to his continuing effort, his place in a hierarchy, his health, his judgment, his ability to remain employable, and the market's willingness to keep paying for that version of him. That is not small. It is just different from ownership. If a man owns 60% of a business that goes from 1 million of revenue to 100 million, the economics of his wealth do not move in a line. The business scales, margins change, valuation changes, market expectations change, and his ownership stake can be repriced upward in a way no salary can imitate. That is why founders often look overpaid to employees. The employee thinks in compensation. The founder, if he has kept enough equity, thinks in ownership. Those are different universes disguised as neighboring houses. The first path to wealth is to build the machine yourself. The public loves this path because it makes the best stories. It gives journalists a hero. It gives young people a dream. It gives people with ordinary jobs a thrilling contrast to their own lives. But the public usually understands this path in sentimental terms. The sentimental version says a person follows his passion, ignores doubters, works hard, and becomes rich. That is children's literature disguised as business analysis. The adult version is rougher and much more useful. A person identifies an inefficiency or unmet demand. He creates a repeatable solution. He standardizes delivery. He scales distribution. He keeps enough ownership so that the scale matters. That is the architecture. Most people who try to build fail at one or more of those points. They create something good but not repeatable. They create something repeatable but not scalable. They create something scalable but fail to distribute it. Or they do all of that and still fail to keep enough equity for the scale to matter economically. That last error is one of the most common. A person builds something real and then gives away too much of the eventual value too early, too cheaply, or too carelessly. He remains important to the company and still does not become wealthy from the machine because he no longer owns enough of it. That is not merely unfortunate. It is a misunderstanding of the game. A wealth engine is not just a profitable activity. A great many profitable activities are still only jobs wearing fancier clothes. A wealth engine detaches. It begins relying less and less on the founder's personal labor and more on systems, customer demand, distribution, process, pricing power, and margin. That is the difference. A local cafe can be a wonderful business. It can feed a family nicely. It can still be a poor wealth engine. if it depends entirely on one operator standing there every day, making sure the whole thing does not wobble off its tracks. Meanwhile, a software business or a digital service with strong margins and durable distribution can scale in a very different way. That does not make software morally superior. It makes the economics different. The world likes to romanticize product quality, but product by itself is not enough. A mediocre product with superior distribution can dominate a market that a superior product with weak distribution never even gets a chance to serve. That sounds unfair to idealists. It is not unfair. It is economics. If nobody sees your X, the market cannot reward it properly. Distribution matters, margin matters, reinvestment matters. People love the phrase, build it and they will come. No. Sometimes if you build it, it dies quietly because no one could find it. The economics could not support growth, or the market was not ready. That is another truth people dislike. Timing matters too. Many founders were not made rich only because they were uniquely brilliant. They were made rich because they entered expanding systems at the right moment. The internet created founders. Mobile ecosystems created founders. Cloud infrastructure created founders. Artificial intelligence and semiconductor demand are creating founders now. A person can be very smart in a shrinking market and do poorly. A person can be merely good in an exploding market and do wonderfully. That does not mean ability is fake. It means timing and market structure amplify ability. A good sailor still prefers a rising tide. The first path, therefore, demands something most people do not possess in the right combination. Tolerance for uncertainty. Tolerance for unstable identity. Tolerance for delayed feedback. Tolerance for looking wrong or foolish, while the machine is still fragile. Income in this path is often unstable. The founder's emotional life is often unstable. The public admires the outcome and ignores the years when the founder was living in uncertainty, signing payroll, swallowing panic, and wondering whether he had built a future or simply created a more exhausting species of anxiety. That is the emotional toll. The payoff distribution is also not normal. Most builders do not become billionaires. Many do not become wealthy at all. Some build good livelihoods. Some fail repeatedly. A few become very rich because they captured the outlier outcome. That is why this path attracts extreme personalities. The upside is asymmetric enough to justify the volatility for those built for it. But what the public gets wrong is that building is not about passion. It is about structural leverage. You are not building a company because you love the abstract idea of effort. You are building a machine that produces value in a form that can scale far beyond the founder's original labor, while you still own enough of it for scale to matter. If it cannot scale, it will not make you rich. If it cannot detach, it will not make you rich. If you do not retain ownership, it will not make you rich. That is the whole harsh beauty of Path 1. Now, not everyone should build. In fact, many people should not. They confuse entrepreneurial glamour with entrepreneurial suitability. The world flatters founders because it sees the outcome and not always the temperament required. That is why the second path matters so much. Buy the machine. This path is closer to my own deepest instincts. You do not invent the productive asset. You identify it, then you buy it, or pieces of it, and let time, cash flow, and compounding perform the heavy lift. An astonishing amount of wealth has been built this way, not through inventing the next thing, through recognizing working engines and owning them long enough. The public often underrates this because it lacks drama. There is no origin story, no dramatic garage scene, no founder mythology, no emotional soundtrack, just capital allocation. And yet, over long periods, capital allocation may be the most civilized road to wealth available. The structure is simple. Accumulate surplus capital, allocate it into productive assets, reinvest cash flow, repeat consistently, avoid catastrophic loss. That is the path. The crucial word there is productive. I am interested in assets that produce. A productive asset generates cash flow, retained earnings, or appreciation grounded in the economics of a real system. Public equities qualify. You own pieces of businesses that continue working whether or not you are awake. Real estate can qualify if the cash flow and structure make sense. Private businesses qualify. Index funds qualify beautifully, which is one reason I have always admired them for ordinary people. When you buy a broad index fund, You are not buying a chart. You are buying a slice of aggregate corporate earnings, low-cost diversification, and a mechanism that regularly throws out weak companies and weights winners more heavily over time. That is not childish. That is one of the most practical ownership tools ever created. What does not qualify in the same way is equally important. Speculation that relies only on someone else paying more later is not the same thing as owning a productive engine. A productive asset either throws off cash or builds earnings power. I want the machine, not only the hope that the machine's sticker price becomes fashionable. That difference becomes enormous over time. And the mathematics of compounding, while simple on paper, are emotionally difficult in real life. If you invest capital at a reasonable rate for decades and keep reinvesting what the asset produces, the curve bends. At first it feels slow, then it becomes interesting. Later it can feel almost unfair compared with the beginning. That is why this path favors duration more than brilliance. People always want to be told that the magic lies in stock picking genius. The truth is much less flattering. The magic often lies in not interrupting a decent process for long enough that the compounding can become emotionally visible. That is harder than it sounds, because human beings want proof too early. They want applause too early. They want the market to flatter their discipline in the first chapter. The market is not sentimental. It gives the biggest rewards to people who can tolerate the long, quiet middle before the curve steepens. Broad markets have historically returned very well over long periods. Rental property has done the same in sensible hands. Good businesses have compounded capital at remarkable rates, and yet most investors underperform the systems available to them. Why? Because they keep interrupting the machine. They buy high when optimism feels good socially. They sell low when fear feels morally urgent. They check balances too often. They confuse opinions with edge. They use leverage badly. They become active when patience was the actual advantage. The second path does not ask that you be dazzling. It asks that you be durable. That is a much fairer request. You do not need to invent the next empire. You need to own pieces of productive systems and leave them alone long enough for their economics to matter. I have always liked that because it separates ego from outcome. If I can buy something sensible at a fair or attractive price and then let time and business performance do the lifting, I do not need to entertain myself with dramatic forecasts every quarter. The world has no shortage of dramatic forecasters. It remains short of disciplined owners. The public also underestimates how powerful the second path becomes once the capital base itself becomes meaningful. At first, the compounding curve insults you. Then it starts helping. Then eventually your own capital contributes more to growth than your fresh labor contributions do. That is when the machine starts feeling almost alive. I have seen this happen in personal portfolios, in insurance float, in reinvested business earnings, in dividends, and in all sorts of other settings. At first you carry the whole burden. Later the capital begins carrying some of it. Then much later it carries more and more. That is the handoff. That is what people abandon too early because the early years did not look cinematic enough. Now there is a third path, and for many intelligent people it is the bridge path. You do not begin with a machine. You do not begin with a giant pile of capital either. So you enter the system. You place yourself where leverage already exists. You become highly paid because your labor sits near large value pools. Then you convert income into ownership before lifestyle inflation eats it alive. This is the path many professionals could travel and far fewer actually complete than should. The first step is skill acquisition, not hobby acquisition, not trend acquisition. Scarce, economically valuable skill, a skill that drives revenue, reduces cost, allocates capital, manages risk, closes transactions, builds systems, or otherwise matters to large pools of money. Scarcity creates pricing power. Then comes system selection. A strong skill in a weak system caps income. A strong skill in a scaling system expands it. That is why the same intelligence can produce radically different wealth outcomes depending on where it is placed. A software engineer building tools used by 10 million users sits inside a different leverage environment from one maintaining minor internal utilities for a sleepy regional firm. An investment banker structuring multi-billion-dollar transactions is in a different economic system from one advising small local deals. An enterprise salesperson tied to large contract values and scalable products can be compensated far beyond someone with similar personal charm in a slower or smaller environment. Scale matters. The market does not pay labor by nobility. It pays labor by economic impact and replaceability. That is one reason high earners cluster in industries like finance, technology, law at the right levels, enterprise sales, energy, and executive leadership inside large value systems. Now, after skill and system comes proximity to capital. This is where many people stall permanently. They become talented operators, useful, respected, comfortably paid, and still they never become wealthy because they remain outside the ownership stream. They do not negotiate stock compensation. They do not secure carried interest. They do not get profit participation. They do not insist on enterprise. Linked upside. They remain hired excellence. That is fine if the goal is a fine life. It is less fine if the goal is wealth. A person in the third path must eventually get close enough to the profit pool that labor can be converted into ownership at scale. That is the inflection point. Then comes aggressive conversion. This is the part most people fail in practice because it runs into ego. A person begins earning $200,000, $300,000, $400,000, perhaps more. Wonderful. The world immediately begins offering him a costume. Bigger house, better car, smarter neighborhood, longer vacations, private school, if he wants to sound serious at dinner. A more flattering version of his life. If he accepts the costume too quickly, he ruins the bridge. That is the tragedy of high earners who never become wealthy. They think the paycheck is the destination. It is not. The paycheck is the bridge. A person earning $400,000 and living on $120,000 has a radically different future from a person earning $400,000 and living on $370,000. The first has conversion. The second has velvet chains. Both may look impressive from a distance. Only one is actually walking toward freedom. This is where the third path turns or dies. Every bonus must become assets. Every stock vest must be treated like the seed of broader ownership, not as proof that the present deserves further ornamentation. Every windfall must be directed toward compounding. The person who does this eventually leaves the control path and enters the ownership path, that is the transition. Labor becomes optional because the pile of owned productive assets has grown large enough to matter. I have watched many people fail just inches before that transition because they could not resist spending enough to keep the ego entertained. That is one reason I am suspicious of visible wealth during the accumulation stage. Visibility often means conversion was interrupted. Now, all three paths have pain. That is important to say because the public keeps imagining there must be one correct road, if only it can be discovered by the fortunate listener. No, the pain is simply different. Building requires extreme tolerance for uncertainty, feedback, identity, instability, and operational pressure. Buying requires patience, discipline, emotional stability, and enough capital to make the curve worthwhile. Joining and converting requires that you become genuinely excellent inside a high leverage system and then resist lifestyle expansion long enough to transfer labor gains into owned assets. None of the paths are easy. They are simple. That distinction matters. Simple and easy are cousins only in motivational posters. In actual life, they are often complete strangers. I would say this: they think effort creates wealth. Effort matters. Structure creates wealth. Effort inside a weak structure just enriches someone else's equity. That is why I spend so much time talking about ownership. Ownership is the hinge. You can create it, you can buy it, or you can earn near it and convert into it. But if you never cross from labor into ownership in some meaningful way, you are very likely to spend your life helping someone else travel one of the three paths. That is a hard sentence. It is still true. This is also why I dislike the moral language around money. People speak as though work ethic alone should guarantee wealth. It does not. People speak as though fairness should reward the diligent. Markets do not grade fairness papers. They respond to value capture. A person can be heroic in effort and still poor in ownership. Another can look calmer and richer simply because the structure underneath his effort is superior. That may offend the sensibilities of people who think effort should dominate the story. I am more interested in what is true than what is flattering. And the truth is that wealth flows toward ownership. The question then becomes not whether you are a good person or whether you are working hard. The question becomes which path, if any, you are actually on. Are you building something scalable and keeping enough equity for the scaling to matter? Are you buying productive assets and letting time perform the heavy work? Or are you positioned inside a high-value system where your income can be converted aggressively into assets before the present consumes the future? If your answer is none of the three, then you do not yet have a wealth plan. You have effort. Effort is noble. It is not enough. Now, I want to add one more thing because this is where people often make a second mistake after finally understanding the map. They hear the three paths and conclude that the first is somehow superior because it sounds heroic. That is vanity again. Not everyone should build. Many people are badly suited to it. They lack the temperament, the appetite for instability, or the willingness to live with long uncertainty and ugly feedback. Fine. I would never urge someone to become a founder merely because biographies made it look romantic. Likewise, not everyone can immediately buy at a meaningful scale. Capital matters there. Some people should enter through Path 3, convert aggressively, and then become major participants in Path 2. The paths can also sequence. A person might join first, then buy productive assets in size. Another might buy steadily for years, learn enough, and eventually build something himself. Another may build, sell, and then spend the remainder of life primarily buying machines rather than building new ones. That flexibility matters. Life does not arrive in neat chapters. Still, the structure underneath is stable. That stability is one it wipes away false hopes. The false hope that one lucky stock will save a weak financial life. The false hope that simply earning a lot and spending almost as much is equivalent to becoming wealthy. The false hope that more hours alone will somehow create ownership without an actual bridge into it. The false hope that looking rich and being rich are neighboring ideas. They are not looking rich, is often consumption. Being rich is usually ownership. That is why the truly wealthy often look plainer than the aspirationally wealthy for longer stretches than the culture expects. The culture sees the car first. Capital sees the balance sheet. I prefer the balance sheet. If I had to reduce all of this to the fewest words possible, I would say the following. Wealth flows to ownership. You can create the thing and own it. You can buy the thing and own it. Or you can work inside the right thing and gradually own more of the productive system rather than merely renting out your labor to it. That is the reality. Not sexy enough for social media, perhaps. Extremely useful in real life. The investor who understands this stops asking silly questions. He stops asking what stock should I buy next week, as though that question alone could repair a structurally weak financial life. He starts asking much more important questions. What do I own? What can scale? How much of the upside am I keeping? How close is my labor to the profit pool? What system am I inside? What percentage of my earnings is being converted into productive ownership? Those are adult questions. They change lives. I do not need many principles in finance. I need a few that survive contact with reality. This is one of them. If it were easy, everyone would do it. Because it is difficult. Most people settle for the comforting lies instead. They compound very poorly.